Major changes for entrepreneurs and investors could be on the way. The Small Business Investment Act of 2025 could supercharge startup funding and unlock massive tax savings. But what does it mean for founders, venture capitalists, and angel investors? Let's break it down. I'm Corey, startup lawyer and founder of Veritas Global Law. If you're an entrepreneur, investor, or venture capitalist, this new bill directly impacts how you raise and invest capital. Today, we're diving into the Small Business Investment Act and its game-changing updates for the QSBS tax exclusion. If you're thinking about raising money, investing in startups, or selling your business, you need to know this. Here's what we'll cover in this video. Lower holding periods for startup tax benefits. S corporations now qualify for QSBS exemptions. Huge tax breaks for early stage investors, and how this impacts venture capital and startup founders. Okay, so let's dig into it. First, faster tax benefits for startup investors. So what's the biggest change? The bill reduces the QSBS tax benefit waiting period from 5 years to just 3 years. Under the current law, you have to hold your shares for 5 years to get a 100% tax exclusion. Under the proposed new law, you can now qualify for tax savings much sooner. A 3-year holding period, you get a 50% capital gains tax exclusion. With a 4-year holding period, you get a 75% capital gains tax exclusion, and after 5 years or more, you get the 100% capital gains tax exclusion. So why this matters? Investors can exit faster with tax savings, making startup investments more attractive. Second, S corporations now get QSBS benefits too. Before, only C corporations qualify for these tax breaks. Now, S corporations can get the same QSBS tax treatment. This is huge for founders who want pass-through taxation while keeping access to major tax benefits. For investors, you can now hold QSBS through an S corporation and still qualify for tax exclusions. Third, convertible notes now count for QSBS. Investors who use convertible notes or safe agreements will be able to qualify for QSBS benefits from the day of investment, not just when they convert to equity. So why does this matter? More early stage investment means that VCs and angel investors can get tax incentives sooner. Lower risk means investors don't have to wait for years for tax treatment to kick in. Fourth, higher after-tax returns for investors. With shorter hold times and QSBS benefits on convertible debt, investors can see tax savings much faster. And this means lower capital gains taxes on exits, more liquidity in venture capital markets, encourages more angel investing and early stage capital. Fifth, more tax protection for high net worth investors. This means there's no more AMT issues. The bill proposes to remove QSBS gains from alternative minimum tax calculations. Passive losses are allowed. Investors can now use startup losses to offset gains. For high net worth individuals, this means smarter tax planning and better returns. To recap, the Small Business Investment Act of 2025 proposes to make startup investing more tax efficient and attractive by lowering QSBS hold periods to 3 years, expanding tax breaks to S corporations, allowing convertible debt to qualify for QSBS. Additionally, this gives investors higher after-tax returns. This is a huge win for startup founders, venture capitalists, and angel investors. Keep in mind, this bill has only been introduced in the House of Representatives and still needs to wind its way through Congress before it becomes law. However, it's important to point out that the National Venture Capital Association has also come out and fully endorsed this bill. Join me on the path to decoding law, technology, and innovation to grow your business. Don't forget to like, share, subscribe, and hit that notification bell. Until next time.